Hey everyone, welcome to Sentiment Trader. Today we're going to be looking at Sentiment Trader's proprietary smart and dumb money indicators. These are our most popular indicators, and they're a great tool for not only measuring overall sentiment in the stock market, but also showing us if we should be excited or apprehensive about that sentiment. So let's get into what is smart and dumb money, how these indicators are measured, and how to read their representative charts. So how do these indicators work? The smart dumb money confidence indices are presented in a number of ways, either on their own or on a spread. So they're measured on a scale from 0% to 100%, and the more significant the gap between the smart money confidence and the dumb money confidence, the more statistically meaningful the information is. And the smart dumb money models are back-tested, meaning what's considered smart or dumb is based on an indicator's historical records at extremes. And we'll be getting more granular by doing a backtesting tutorial into these indicators in the near future. So stay tuned for that. Subscribe to Sentiment Trader for all future videos. And when the dumb money is below the smart money, that means the sentiment is negative, meaning stocks are usually struggling, and it's best to be defensive at times like this. However, when stocks become too negative, they often rally over the next 1 to 3 months. And this usually occurs because the dumb money has dropped below 40% and the smart money has risen above 60%. And when smart money confidence, for example, hits 100%, that means that those most correct on the market direction are 100% confident in a rising market. When it's at 0%, the other end of the extreme, it means that these good market timers are 0% confident in a rally. So, and the complete opposite is true, obviously, for dumb money confidence. If it's at 100%, that means that these bad market timers are supremely confident in a market rally. And history suggests that when these traders are confident, we should be ready for a market decline. So let's get into the DNA here. Some examples of the smart money indicators include the OEX put call option open interest ratios. The OEX is like the S&P 500, but for options. It's the 100 largest U.S. stocks by market cap. Also, it takes into account commercial hedger positions in the equity index futures. So what that means is, like, portfolio managers will often buy equity index futures as a hedge against potential losses. Index futures can be used to bet on the direction of all 500 stocks, with one contract creating the same effect of owning all 500 stocks in the S&P 500. Also, we look at the current relationship between stocks and bonds. The rationale seems that, from the fact that bonds are generally considered less risky investments than stocks. Therefore, bond issuance rates are, as they increase, there's a demand from investors to move out of stocks and into bonds. And some examples of dumb money indicators include the equity-only put-call ratio, the flow in and out of the RIDEX series mutual funds, small speculators rather than commercial hedgers in the equity future contracts. And, this can really give us a snapshot into what the masses are thinking beyond what's on the mainstream media, beyond what's in social media, beyond just the noisy consumption habits of many people in the modern era. And it really gives us a sense of what's trending in the macro.